Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer at Worth Asset Management. Today is December 12th, 2022. I'm going to go over your three threes for the week. I'm going to go over the major asset classes, their performance for the week, and our top three, and how we are positioned on both equities and bonds in the short term. And we've got some really good market movers this week, so I'll go over our top three. So let's jump on in.
Okay, let's go over the major asset classes performance for the week and year-to-date basis. The U.S. equity markets fell during the week on mixed economic data as traders and investors balanced concerns about a potential recession in the U.S. with possibly more aggressive tightening by the Federal Reserve that will be meeting this week on Wednesday. For the week, the Dow fell 2.8, the S&P dropped 3.4, and the NASDAQ dropped 4%, while small caps dropped 5%. So as we took a big step forward last week, we just took 2 steps back. We have the international markets down 1, real estate down 2, commodities down 3.7. We did have the US dollar, gold, and Bitcoin slightly up, so they were the winners for the week. On a year-to-date basis, we unfortunately did not chip away at these negatives, so they actually got more red on a year-to-date basis, while we still have the US dollar and commodities as our 2 major winners. All right, let's go over the top 3 asset classes on a long-term basis for December 12th, 2022. And we have had a change. We have had the US dollar in the number 3 spot, and we now have utilities, which have jumped the US dollar. So we have T-bills, dividend equities, and utilities. Now, keep in mind, even though these are equities, they are very defensive in nature. So defense is still on the field, except now investors are starting to dabble and they want to take some additional risk in some of these beaten down areas. 1 year ago, on December 12th, 2021, we had the NASDAQ, S&P, and long Treasury bonds as our top 3 asset classes. All right, so let's go over the bonds on a short-term basis. And if you've been following and watching these, 4 or 5 weeks ago, we started nibbling and buying bonds. They broke our indicator, so we started nibbling, and so far so good on our bonds. And this is the second time we've started nibbling. Back here, we started to go to protect mode at the end of August, and the bonds dropped 4%. And for the beginning of the year through about July, the bonds dropped 9%. On a year-to-date basis, they're down 11%, but that's what the index is down. That's not what our clients' portfolios are down. All right, let's go over the equities on a short-term basis. Year-to-date performance down 17.5%. Again, it wasn't a great week for equities. However, we did start nibbling here at the end of October, and so far so good on that, still up 7.2% since that marker. And again, this is the 3rd time that we have started to nibble in the equity side. Each one is rolled over. We shall see what this one does. And however, the good news is these are the resistance and support zones, and we went up and we did not go ahead and get in that resistance zone. We broke away from it, but the support is holding. So that's good news so far. And the other thing is you can see here, this is still a bear market rally because we have lower lows and lower highs, okay? So we've got to finally break out of this resistance zone and get above this before we probably get an all clear for the S&P 500 for the major growth areas for this market. All right, let's go over the top 3 market movers this week, as they are going to be pretty big. On Tuesday, we have the Consumer Price Index, or the CPI, coming out, and that's the consumer inflation gauge that the Fed looks at. And the headline prices are projected to have now risen 0.3, so that's not great on a month-to-month basis, but on a year-to-year basis, they are set to tick down to 7.6 from 7.7. So as long as we stay below 7.7, that will be a positive for the market. On Wednesday, we have the December FOMC policy meeting, and they will come out on their choice on whether or not they're raising interest rates or lowering interest rates. And right now, it's about a 70% chance that they're going to raise interest rates by 50 basis points. That could change if Tuesday comes in hotter than expected. But right now, it's probably going to be 50 basis points, which will put us at 4.25 to 4.5 on the benchmark federal funds rate. Now, Thursday, which will be the third market mover, probably the least of the three, will be retail sales, unless it's a very blowout number or a fail. So right now we are seeing they have declined for the month because last month was a very strong gain in retail sales at 1.3. But on a year-to-year basis, it's still, the consumer is somewhat strong. Retail sales right now are at 7.9. Yes, that probably has something to do with all the discounts that they're providing, but at least they're out there spending. All right, that's it for this week. Thank you for joining us. Our next update is Monday, December 19th. As always, continue to follow, like, and subscribe, and we will see you again next week. Have a great week trading.